Sunday, January 25th, 2026, markets closed, but the price of silver doesn't care. Because while traders sleep, while Wall Street rests, physical silver is still moving, still being bought, still disappearing. And when markets open Monday morning, they're going to wake up to a reality that most still refuse to accept. Silver just crossed $100 per ounce for the first time in human history. Not paper silver, not COMEX futures, physical, metal, in your hand. $100.03 in Shanghai. $98.71 in Dubai, $95.49 in London physical markets. The number you see on your screen, $92 on COMEX futures, that's not the real price anymore. That's the price of a promise, a contract, a piece of paper that says you own silver. But try to actually get that silver delivered. Try to convert that paper into metal. See what happens. Because here's what nobody's telling you. The spread between paper silver and physical silver just hit the highest level in recorded market history, $8. Sometimes 12. The gap is widening every single day. And it's not narrowing, it's accelerating. January 23rd, 72 hours ago, silver broke through $95, smashing every record, leaving even the most bullish analysts speechless. First Majestic Silver's CEO, Keith Neumeyer, the guy they call the triple-digit silver prophet, the man who's been predicting $100 silver for years while everyone laughed, finally got vindicated. He went on Arcadia Economics and said, quote, triple digits is definitely on its way. That was 48 hours before it happened. The man wasn't guessing. He was watching the same data we're about to show you. Data that proves this isn't a rally. This is a structural market failure happening in slow motion. This is what it looks like when 50 years of paper manipulation finally meets the brick wall of physical reality, and the wall just won't move. So let's talk about what actually happened. Let's talk about the numbers that Wall Street doesn't want you to see. Because between January 7th and January 14th, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX registered warehouses. Gone. Delivered. Removed from the exchange entirely. That's 26% of COMEX's deliverable inventory in 1 week. Not shuffled between accounts. Not moved from registered to eligible status. Withdrawn. Loaded onto armored trucks. Driven to private vaults. Locked away. Never coming back to the exchange. This has never happened before in COMEX history. Not during the Hunt Brothers Silver Corner in 1980. Not during the 2011 spike to $50. Not ever, and it's not slowing down. Not. Here's what makes this even more insane. The contracts demanding delivery, they're not waiting for March, which is traditionally the most active silver delivery month. Traders are rolling backwards. They're exchanging March contracts for January contracts and paying premiums to do it just to get their metal now. This week, today. They don't want to wait 60 days. Why? What do these institutional traders with billions of dollars and teams of analysts know that retail investors scrolling through their phones don't? They know the market is breaking. They know that in 5 years of consecutive deficits, 678 million ounces of silver have been consumed that were never replaced. 678 million ounces. That's not a number. That's a catastrophe unfolding in real time. Where did that silver come from if mine production couldn't supply it? It came from above-ground stockpiles, exchange warehouses, bank vaults. Strategic reserves built over decades, and those vaults are now approaching empty. The Silver Institute published their data. 2024 saw global silver demand hit 1.17 billion ounces. Mine production, 835 million ounces. That's a deficit of over 500 million ounces in a single year. But 2025, the fifth consecutive year of deficit, 95 million ounces short, even after accounting for recycling hitting a 13-year high. 5 years running, 820 million ounces cumulative deficit. That silver is gone, used in solar panels that are now on rooftops generating electricity, embedded in electric vehicles driving down highways, soldered into circuit boards and smartphones and laptops and data centers. It's not coming back. Silver, unlike gold, gets consumed, and we just consumed 5 years' worth of surplus inventory. Now let's talk about why this is accelerating, not slowing down. Because the forces driving silver demand aren't temporary. They're not cyclical. They're structural megatrends that are intensifying every single quarter. Solar panels. The photovoltaic industry alone consumed over 25% of annual global silver supply in 2024. Each solar panel requires 15 to 25 grams of silver. Sounds small, right? Until you realize that global solar installations are projected to hit 500 gigawatts annually by 2030. That means the solar industry will need 250 million ounces of silver every single year, just for solar. The International Energy Agency forecasts solar capacity will expand by 3,200 to 4,400 gigawatts by 2030. Installed PV capacity has increased tenfold since 2013. China alone accounted for 51% of that growth, Europe 15%, USA 9%. And silver demand in PV has risen nearly 4 times. This isn't slowing down. This is the new floor. Electric vehicles. A standard EV uses 25 grams of silver. Larger models use 50. But here's where it gets wild. If solid-state silver batteries become standard, which multiple manufacturers are racing to develop, each EV could require 1 kilogram or more of silver. That's a 40 times increase per vehicle. The Silver Institute estimates automotive silver demand will grow at 3.4% compound annual growth rate between 2025 and 2031. And demand from EVs will overtake internal combustion engine vehicles by 2027. Not might, will. Because EVs use 67 to 79% more silver than traditional cars. Every charging station, every power inverter, every battery management system, silver. Data centers and artificial intelligence. This is the monster nobody's talking about. Global IT power capacity increased by 53 times from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. A 5,252% increase in power demand, and every server, every switch, every high-performance computing cluster powering AI models, they all require silver for electrical connections, thermal management, and signal integrity. As AI adoption explodes, as ChatGPT and Claude and every other model scales, as companies build massive GPU farms for training, the demand for silver in data infrastructure is growing exponentially. And this demand is price inelastic up to a point. You can't build a solar panel without silver paste. You can't manufacture an EV without silver contacts and connectors. You can't run a data center without silver-coated components. Industries tried to reduce silver usage. They really did. Solar manufacturers achieved 15 to 20% thrifting in a single year through copper plating and thinner silver layers. But here's the problem. Even with optimization, even with companies desperately trying to use less silver per unit, total consumption keeps rising because production volumes are exploding faster than efficiency gains. It's like trying to bail out a sinking ship with a teaspoon while someone's drilling new holes in the hull. You might reduce how much water each hole lets in, but you're still sinking. And now let's talk about supply. Because if demand is exploding, surely miners can just produce more silver, right? Wrong. 72% of primary silver is produced as a byproduct of mining other metals: copper, zinc, lead, gold. You don't just open a silver mine. Most silver comes from polymetallic operations where silver is secondary, which means silver supply is constrained by the economics of those other metals, not by silver price. Even if silver hits $150, if copper prices are weak, those mines aren't expanding. Global mine production in 2024 was 819.7 million ounces, up less than 1% from the previous year. Less than 1%, despite silver prices doubling, despite a massive deficit, despite screaming market signals that more supply is needed. Because you can't just flip a switch. Discovering a new silver deposit takes years. Permitting takes more years. Building a mine takes even more years. Even existing mines can't simply double production overnight. There are geological constraints, equipment limitations, labor availability, environmental regulations. The silver market is discovering that supply is far more inelastic than anyone assumed. And this creates a feedback loop that's absolutely terrifying if you're short silver or rely on cheap silver for manufacturing. Higher prices incentivize production, but production can't respond quickly, so prices go higher, which eventually incentivizes substitution and efficiency. But substitution takes time to implement, so prices go higher still, until something breaks. Now here's where this gets absolutely wild. The United States government just added silver to the critical minerals list in 2025. Let that sink in. Silver is now classified the same as rare earth elements, the same as lithium, the same as cobalt. This isn't just a precious metal anymore. This is strategic infrastructure. This is national security. Because without silver, you can't build the renewable energy grid. You can't manufacture advanced weapon systems. You can't produce the electronics and communications equipment that modern militaries depend on. China, which controls 51% of global solar manufacturing, is importing massive quantities of silver, not just for industrial use, for strategic stockpiling. The renminbi's real effective exchange rate has fallen nearly 20% since early 2022. Chinese citizens are fleeing local currency into hard assets, gold, and increasingly silver. Bank of America's metals research head Michael Widmer isn't messing around. His forecast? Silver could reach $135 to $309 per ounce in 2026. 309. Not a typo, not clickbait. That's Bank of America's institutional research desk putting out official price targets. Why? Because he's looking at the same math we are. $4.4 billion in concentrated short positions held by banks, industrial demand consuming 60% of annual global output, and a physical supply that's genuinely limited. The analyst who broke down the short position explained it perfectly. Covering those shorts would require years of mine supply, much of which is already committed to manufacturers. And here's the kicker. You can manipulate paper prices temporarily through futures market games and high-frequency trading and margin requirement changes. We saw that in late December when CME Group hiked margin requirements and silver crashed $15 an hours. But you cannot manipulate physical supply that doesn't exist. There's no scenario where shorts cover these positions at current prices. The math doesn't work. Either prices go dramatically higher to incentivize enough supply and demand destruction to balance the market, or the COMEX defaults on delivery and the paper market collapses entirely. Those are the only two options, and we're watching this play out in real time through the Shanghai COMEX spread. Physical silver in Shanghai trading at $103 while COMEX futures quote 92. That's an $11 premium for physical metal. In a properly functioning market with efficient arbitrage, such spreads should be impossible. Buy on COMEX at 92, take delivery, ship to Shanghai, sell at 103, $11 risk-free profit per ounce, except the arbitrage isn't working, which means either the logistics are broken, COMEX can't actually deliver the metal the contracts represent, or export restrictions are preventing silver from flowing west to east. Investment demand is surging. Silver-backed ETF inflows increased 40% in 2025 after nearly 2 years of outflows. Retail buying of physical coins and bars has overwhelmed mints. The U.S. Mint is operating at maximum capacity and still can't meet demand. Premiums on American Silver Eagles are running 15 to 25% over spot price. Some dealers are paying above spot just to acquire inventory, then marking it up further for retail. People are chartering private planes to collect large silver purchases from dealers in different cities. This is not normal market behavior. This is panic buying. But here's what's critical to understand. This isn't driven by retail investors on Reddit trying to squeeze shorts. This is institutional. This is sovereign wealth funds. This is corporate treasuries. This is family offices managing billions. They're diversifying into physical precious metals because they're terrified. Terrified of currency debasement. Terrified of inflation that official CPI numbers don't capture. Terrified of geopolitical instability. Terrified that the financial system they've relied on for decades is more fragile than anyone wants to admit. And they're choosing silver over gold in many cases because the gold to silver ratio, which peaked above 107 in April, has fallen to 78. Silver is cheap relative to gold, and it has explosive upside if industrial demand continues accelerating while supply constraints persist. Now let's address the elephant in the room. Can this continue? Or is this a bubble about to pop like 2011 when silver briefly touched $50 before crashing? The bears have arguments. They always do. CME margin hikes can cool rallies by forcing leveraged traders to reduce positions. Fed policy could shift hawkish if inflation reaccelerates, strengthening the dollar and reducing safe haven demand. Supply might increase later in the year as high prices incentivize production. Risk headlines could fade, unwinding safe haven flows. These are all valid points. Silver is volatile, the devil's metal they call it. It can fall as fast as it rises. But here's the difference between 2026 and 2011. 2011 was an investment bubble. The market was actually in surplus. When speculative fever broke, there was no underlying supply deficit to support prices. They crashed from 49 to 26 in less than a month. Today, an 820 million ounce cumulative deficit, structural supply constraints that can't be fixed quickly, 3 megatrends, AI, EVs, solar accelerating simultaneously rather than sequentially, industrial demand that's price inelastic until much higher levels. This isn't speculation. This is fundamental supply-demand imbalance, the kind that doesn't resolve with a margin hike or a shift in trader sentiment. The kind that requires either massively higher prices to destroy demand and incentivize substitution, or a recession so severe that industrial production collapses. And even in recession scenarios, investment demand for silver as a monetary metal could offset industrial weakness. We saw this in 2008. Industrial silver demand fell, but investment demand exploded. Price stayed elevated. So where does this go? Conservative analysts say 120 to 150 by year end. Aggressive forecasts say 200 plus. The truly wild predictions, like the one circulating that shows silver potentially hitting 300 if short positions can't be covered, sound insane until you run the math. If banks are short $4.4 billion worth at current prices and industrial demand consumes 60% of supply, where does the physical metal to cover those shorts come from? It doesn't exist. Not at $92. Maybe not at 150, maybe not at 200. At some price point, industrial users start substituting copper where possible. They redesign products to use less silver. They implement recycling programs. Demand destruction happens, but that price point is much higher than where we are now, because industries have already been trying to reduce silver usage for years as prices rose, and total consumption is still increasing. Here's the bottom line. Sunday, January 25th, 2026. Silver is $100. Physical premiums are exploding. COMEX inventories are draining. 5 years of deficits have consumed 820 million ounces of above-ground stockpiles. Solar, EVs, and AI are creating structural demand that won't disappear. Supply can't respond quickly, even at triple-digit prices. The paper market is fracturing from physical reality, and institutional money is just starting to wake up to what this means. If you're holding physical silver, you're holding an asset that's simultaneously a precious metal, an industrial commodity, and a strategic material. If you're short silver, you're betting against mathematics. And if you're sitting on the sidelines thinking you'll buy after it corrects, ask yourself this: what correction? What would cause a sustained reversal in a market that's been in deficit for 5 consecutive years and where every dip gets bought instantly? The music is still playing, the party is still going. But the difference between this and previous rallies is that this time, there actually aren't enough chairs for everyone when the music stops. Because the chairs, the physical silver, are already gone, used, consumed, embedded in products that won't be recycled for decades. This is the silver market in 2026. $100 is not the top. It's not even the middle. If the analysts at Bank of America, Goldman Sachs, and major mining companies are right, if the structural deficit persists, if industrial demand continues accelerating, $100 is just the beginning. The real question isn't whether silver goes higher. The real question is how high, how fast, and who gets caught on the wrong side when the paper market finally admits it can't deliver what it's promised. Welcome to the silver squeeze, the real one, not driven by Reddit, driven by physics, chemistry, and the mathematics of supply and demand, and it's just getting started. Secret exposed.